this kind of a error happens because you end up falling in love with your stock. Something which has done very well for you is most likely candidate for this kind of an error.
So investing is not ego, it is not falling in love with what you invest, it is about a pure commercial decision which you need to take.
Yes, more than a commercial decision, I will say it is a dispassionate decision making with a balanced mind that is important.
I'd like to throw in one more ingredient, and a very real example here is importance of relevance. I mean, the place where we are sitting was a mill. In 1960s, 1970s, cotton mills in Bombay were throbbing. They were the most exciting business. But now the relevance has completely died down. For a terminal value investor who's thinking of long-term evolution, how do you really understand that, okay, the management was good, it was a gorilla, but unfortunately that gorilla is now becoming extinct because of its viability. So it's not a monkey, but the sheer importance of that business, of that gorilla, is no longer required in the jungle. How does one figure that out?
Which means the mega trend went against you.
Okay.
Which means the cotton mill mega trend was over. So irrespective of whether you're holding on to the leader in that space or not, you did not have the mega trend with you. Remember that we talked about three things: mega trends, leadership, and intangibles. You need all three.
I'm just connecting all these on purpose so that our viewers can start, relating to them. In case you missed the first series in terms of mega trends, please watch it again. When you're trying to look at, connecting the dots here, please watch the entire series so that you can understand that ultimately it's the matrix and the framework is what we're trying to establish here. Again, there would be a error here which could be called as type 1.5 error in selling. How does that work?
Yeah. So type 1.5 error in selling is where the stock has typically done well for you. You sell a bit, but not enough. Okay. Now, this is typically where you are still in love with your investment. You're only balancing your portfolio despite the fact that the hypothesis has changed. Maybe the mega trend has played out. Maybe there is a leadership issue. Maybe there is an intangibles issue. And yet you did not sell. And then the stock either underperforms or goes into negative. See, a correction in a stock price is not a problem. As Buffett and Munger have taught us, what we are concerned with is permanent loss of capital. We are not concerned with temporary loss of capital or quotational loss, as they say. Type 1.5 error, we are talking about not being able to adequately avoid permanent loss of capital.
And the type 2 error here perhaps is the most important one. You should have not sold where the value is high and the journey in the highway is very long.
So type 2 error situation is such that you've bought something based on a differentiated insight and conviction. That hypothesis has been validated. It has become a gorilla for you. It has already done well for you. Yet, you are anxious or insecure about the gains that you have made, or due to maybe some macro noise, and you expect the market to fall, or you feel that I've just made too much money. I don't want to lose any part of this. I want to lock it in. And that anxiousness and insecurity is leading to you selling what should not have been sold. Now, the opportunity cost of selling what should not have been sold is not just in the quantum of money that you left on the table, but it is also what it does to the weightages in your portfolio.